Good morning and welcome to Shelze Fiscal webinar series. My name is Ifeoluwade today and I'll be moderating this morning's session. Today is Tuesday, 19th of May, 2026, and we are now in webinar number 3 of our ongoing series on practical tax compliance under the Nigerian Tax Act 2025. Today's section is titled, Is Your Business Charging VAT Correctly? What's taxable? What's exempt, and what you can claim back under the NTA 2025. So a few housekeeping points before we begin. Your microphone is muted. Please keep it muted throughout. If you need to contribute, use the chat box. And for questions, you can type them in the chat box at any point during the session. We have a dedicated Q&A segment at the end, and I'll be monitoring the chat throughout. So if your question is not addressed live, it will be answered in the written post-section summary. This session is being recorded. The recording, along with a summary document and a bonus VAT classification reference guide, will be sent to all registered participants within 24 hours. We have 2 polls during the session. Please participate when they appear. The results will inform the discussion. So just a quick note on why this session matters today. Specifically, the NTA 2025 took effect on 1st of January 2026. This is now nearly 5 months ago. In that time, many businesses have continued to operate on VAT frameworks built for the law that was repealed. The classification of certain supplies has changed, and the rules on which input VAT you can recover has been updated. The basis on which VAT is accounted for has also been tightened, and none of this is theoretical. It is live audit exposure. Our session this morning is designed to give you the precise statutory grounding to identify and close those gaps. It is now my honor to introduce the Managing Director of Shelze Professional Services, Mr. David Apaflo, who will set the context for our session. Over to you, Mr. David.
All right. Good morning, everyone. Thank you for joining us today. And I really want to begin this session with an observation. Since the Nigerian Tax Act came into force, one of the key questions, I've been asked a lot, especially pertaining to VAT from finance leaders, CFOs, is, really how much of difference do we have between, the Nigerian Tax Act, the Value-Added Tax Act that we had before. And, of course, the question makes sense because when you look at it, it seems like the VAT rate is the same. The monthly filing cycle, you still need to file before the 21st of the next month. It's still the same as what we had before. And, the basic input, the output minus input mechanism still appears the same, right? And so it looks like not much has changed. And, that really is the problem, right? On the surface, right, the similarity conceals the changes that really, really matter, right? So the classification of exempt and zero-rated supplies have been restructured. Some items that used to be exempt are now zero-rated, and there are, of course, implications for that reclassification and restructuring. Rules around cross-border VAT, specifically with respect to international delivery terms. If you are into international trade, right, some of the rules with respect to the different delivery terms or Incoterms, have also changed and have been codified in ways that, might need you to update your planning positions or your structure, your compliance structures. There are also new rules around, settlement in barter transactions, where you're, of course, exchanging like for like or exchanging product for product instead of, exchanging money. So there are rules on barter transactions. There are also new rules around construction contracts, which may be billed progressively in line with what IFRS 15 recommends. And all that applies to the VAT system that we now have. We also have new rules around what happens when a client doesn't pay you. So accrual basis versus cash basis, we need to look in depth. And so these are real issues that are affecting every business in every sector in Nigeria today. And so this morning, our speaker, Kolawole Olaniyan, who is a tax associate with our fiscal practice, Shelze Fiscal, which is basically the tax, trade, and regulatory services practice of our firm, has spent considerable time mapping out these provisions that I have just described against, the actual supply chain structures, the contract structures, and it's going to present this in a way that is grounded in what the laws and the statutes say. And so it is important that we pay attention to this because the Nigerian Tax Act is already in force. And so the application of some of the things we're going to be learning today are actually immediate. If I would even say some might have already been passed, but it's better late than never. So my request to you is basically to treat this as a compliance review, not just an information section, right? You need to think about it every time a question comes. You should be asking, how does this apply to your business? If there is a compliance gap that you need to close, and if, of course, your answer is yes, because your current treatment is different from what the law prescribes, then it is an action item that you need to put down, write it clearly, and decide what you need to do going forward. Thank you very much. Over to you, Ife.
Thank you so much, Mr. David. So our speaker today is no other person than Kolawole Olaniyan, who holds a Bachelor of Science degree and is also an associate of the Institute of Chartered Accountants of Nigeria. He is a tax associate in Shelze Fiscal practice, specializing in indirect tax and the application of the Nigerian Tax Act 2025 to commercial transactions. Kolawole Olaniyan, this section is yours. Over to you.
Thank you very much, Ife. Thank you very much, David, for that wonderful introduction. So, as David has mentioned, today's webinar is going to be split into different pillars. So we have decided to split the new changes according to the NTA 2025 into 4 pillars, so we can all easily understand what we are talking about. And the first pillar that we're going to be discussing is the pillar 1, which speaks to VAT taxable supplies and place of supply. So now, when we are referring to VAT as a form of taxation, right, the NTA 2025 has essentially changed the way VAT is being recognized. So when we look at the wordings of the law, according to the section 146 of the NTA, it directly refers to, charging of VAT with the wording of place of supply. So products are generally divided into 2 categories. We have the goods and we have the services. As for goods, the vitiating element in the law states where goods are physically present, imported to, assembled, or installed in Nigeria. We can say a VAT liability has arisen when VAT is imported, physically present, assembled, or installed in Nigeria. Additionally, another test is if the beneficial owner of the right to that product, right? If that beneficial owner is in Nigeria, you can be the owner of a product, right? Not necessarily being the one receiving stock of a particular item, but because you are the beneficial owner to the rights of that particular product, and you are a taxable person in Nigeria, so there's going to be a VAT liability arising for those kind of goods. And the other leg, which is for service, right? The essential element to recognize VAT on service is if that particular service is provided to and consumed by a person in Nigeria. So the law has changed from where a contract, was written, or, where you had an agreement. Now we are looking at where was this service consumed, or where was this good consumed? Was it imported into Nigeria? Was it not? So that is the vitiating element determining if VAT is chargeable to a particular product. So once again, the place of supply is the essential element that we are looking at. Now, for services, right? So examples of services, like we mentioned, are, when you are receiving management fees, software licenses, you are paying for management fees, you are paying for your software licenses, or you are paying for a cloud hosting service from a foreign provider. So the law is no longer looking at if such a provider is a Nigerian firm. So far, you are the one consuming such a service and you are domiciled in Nigeria, that transaction is what is VATable. However, there is an exemption to this rule for small businesses, right? To claim this condition, to claim that you are a small business under the NTA 2025, right, you must meet two criteria. The first criteria is if you have a gross annual turnover of below 100 million and your total fixed assets is also below 215 million. So you actually have to qualify for these two items before your business can be considered a small business and you won't pay VAT on your transactions, right? There is an exemption to this small business threshold, and this exemption applies to professional services. So for people who are running a consultancy business, people who are working as lawyers, architects, accountants, engineers, even if they fall below, even if their turnover falls below 100 million, right, they would still have to pay VAT because they cannot enjoy this exemption according to what is in the law. And one other element that causes discrepancy in the field is where a business was previously a small business but has now become a large business. So what do you do? So on crossing the 100 million threshold as a business, you are meant to file your monthly VAT returns and you are meant to pay your VAT liability accordingly. Next slide. Now, we are now going to be looking at something else, which is time of supply and what counts as a taxable supply. Now that we know that the essential elements that dictates if a VAT liability has arisen is if that product was consumed, imported in Nigeria, or if that service was consumed in Nigeria, irrespective of who is providing such a product, right? The other element that we will not discuss now is time of supply. So according to section 146, subsection 3, the standard, application of time of supply is where supply occurs at delivery or when the goods are made available or when payment is made, right? Now, you see, time of supply is important to recognizing VAT liability. We need to know when was this product or when was this service actually supplied, because it is when such a supply occurs that the VAT liability, occurs, right? Now, the law is saying it is no longer when payment is being made, right? A supply occurs when delivery is made, the goods are made available, or payment is made, whichever comes first. So you can supply, a particular consumer your products and you might not have received payment, right? VAT liability will still arise if such a transaction has occurred, even if those transactions were made on credit. That is what section 146 subsection 3 refers to when we talk about time of supply. Now, we are now looking at other forms of businesses, right? So you can run, a contractual agreement or a contractual business where, you receive payments instrumentally. For example, you can be in the business of, leasing out a particular asset, right? You can be in the business of, constructing a road and you are receiving your payments instrumentally or gradually as such a business, as such a service is rendered, right? Now, for such business transactions, the VAT liability is recognized as soon as you perform those obligations, right? So as you perform the first obligation for your first installment, you have to recognize the VAT liability. As you perform the second obligation, you have to recognize the VAT liability, right? So you don't necessarily need to wait to the completion of such a project before you start to recognize the VAT liability on such transactions, right? Now, another element, right? Another thing that might cause confusion are retentions. So essentially, what are retentions? So a retention is when you have a contract with someone, right? A counterparty, and you tell this counterparty that you are going to retain a certain element or a certain payment, in that contract until a particular obligation has been met in the future, right? Until such an obligation has been met, you don't need to recognize VAT liability, right? We cannot say supply has occurred when such an obligation has not been met. So VAT liability is incurred when a supply has occurred. So if you have not met that obligation in the future, you do not recognize VAT liability. So now that's the first leg. The second leg refers to what is a taxable supply, right? When we are talking about taxable supply, we are looking at the nature of the supply, the product, the good or service. And what are we now looking at? We are looking at if the product you are supplying, if the service you are supplying is zero rated and not exempt. So that is what we are referring to. So now, a zero rated, all right. So back to what I was discussing. So now, Section 201 defines a supply as any transaction where the property in whole or in goods is transferred, or where the agreement expressly contemplates a transfer is going to be made. Right now, the crucial elements in this section is they don't even need you to make the supply, right? Once you already have an agreement that expressly contemplates a supply is to be made, you are actually meant to recognize VAT, because such an agreement, establishes taxable supply according to Section 201, right? Now, what are examples of transactions that can form taxable supply? We have transactions that relate to sale of goods, right? You can sell your products, leasing arrangements. We have hire purchase arrangements, agreements. We have the disposal of goods. We have when you receive management fees, software licenses, so on and so forth, right? So that's the difference between time of supply and what constitutes a taxable supply. So the next slide now is going to be speaking about, what we discussed in the previous slide, which is what constitutes a taxable supply. We are now going to be looking at what goods are zero-rated goods and what goods are exempt goods. So we've seen that this concept causes confusion amongst taxpayers, amongst professionals. Now, let's speak about the first classification, zero-rated goods. What are zero-rated goods? Zero-rated goods are goods which their output VAT is charged at 0%, right? That is the basic definition of what zero-rated goods are, right? Their output VAT is charged at 0%. Now, for goods like this, right, if the business is making a taxable supply, right, even though those products are zero rated, then we can say these goods still remain in the VAT system. Additionally, for zero rated goods, you are allowed to actually claim full input VAT, that you have borne on purchasing, the costs or the inputs that you use to produce that particular product. This is what we are saying. When you are trying to manufacture a product and you incur costs of production, cost of raw materials on such a product, if your products are zero rated, you are still allowed, to recover the input VAT that you paid trying to get those cost of materials. But you are not going to charge output VAT. Your output VAT is going to be at 0%. So that is the definition of zero rated goods. So you can also check section 188, right, of the NTA 2025. It has an exhaustive list of zero rated products. Now, apart from this, let's now look at the second classification, which are exempt goods. So what are exempt goods? Exempt goods are goods that no output VAT is charged at all, right? So under this product classification, the business is not making a taxable supply and it operates outside the VAT system. Apart from this, right, another element of exempt goods is no input VAT recovery costs are attributable to these kinds of products. Now, can you see that? You see that when we're discussing zero-rated goods, we said their input VAT can be recovered with proper documentation. But for exempt goods, you cannot recover your input VAT, right? The only thing you can do is if you have incurred input VAT, you are meant to recognize these costs as a permanent cost to your business, then integrate the input VAT that you have borne into your product pricing, into your service pricing, right? Now, that is the difference between zero-rated goods and exempt goods, right? Now, we are going to be discussing the second pillar. In the first pillar, we have been able to differentiate, we have been able to explain how VAT is recognized under NTA 2025 and how that was different from the former legal provisions. In this second pillar, we are going to be discussing something even more technical, which are Incoterms and cross-border VAT. Now, what do we mean when we refer to Incoterms and VAT, right? So we are going to be looking at three high-risk terms. And what are these terms? These terms are Ex Works, Free on Board, and Delivered at Place. So before we begin, what is Incoterms? Incoterms is an abbreviation that stands for International Commercial Terms, right? So now, for, who engage in international trade, who import goods, who export goods, right? So we've seen in the field that what most people do is they reference the Incoterms, right, to determine when supply has occurred. However, according to the NTA 2025, there is no provision in the NTA 2025 that actually references this Incoterm, right? So this is why the correct regulation that is that surrounds international trade falls under section 146, which references the place of consumption, right? Now that we understand what Incoterms stands for, let's now discuss those three technical terms I mentioned earlier. Now, the first technical terms refers to Ex Works. Ex Works. Now, what does this mean? The meaning of Ex Works is a purchase arrangement where a seller, decides to actually produce a product, and his obligation to the buyer ends after producing this product and after the product has left his factory. Immediately that product leaves the factory of the seller, the obligation, every single liability, the care for that product, every single thing passes on to the buyer, right? Now, what is the tax effect of this particular arrangement? The tax effect of this arrangement is that most sellers, right, cannot obtain an export proof on this product because, like I said earlier, these products refer to products that are sold on the international market, right? So now, when sellers are trying to claim VAT on these products, they are not able to show that these products are actually exported products, right? And they won't be able to, say that their products are zero rated. So what happens? What happens is that they eventually still have to pay the standard rate of 7.5 on this exported product. They could have easily avoided this if there is export proof. But because the buyer is the one taking control of those products, they don't have the documentation to show that these goods were actually exported, and they eventually end up paying VAT, where they could have easily showed that their product is zero rated. That is the first technical term. The second technical term is the free on board term, FOB. Now, what does this refer to, right? The free on board is an arrangement where the seller delivers to a vessel at a Nigerian port, right? The seller himself, delivers that product to a vessel, and the seller also holds the bill of lading as proof of export. In this scenario, right, you can see that the seller has documentation to actually show that, these products are exported, so therefore they are also zero rated. So for this, it's easy to claim that your products are zero rated, enjoy, the relief on input VAT. Now, the third classification of products are the ones that are delivered at place, which are the highest risk. Now, we have to pay a little more attention to this particular term because a little bit technical. We are going to break it down as easy as possible. Delivered at place refers to a product where the goods are delivered to the buyer's named destination, even if the buyer is not a Nigerian firm. The buyer can be a foreign entity. It's just like saying a firm in Nigeria wants to sell a product to a buyer outside Nigeria, right? And that buyer outside Nigeria is telling the firm, oh, don't deliver the product to me, deliver the product to my branch that is still in Nigeria, right? So that is what we refer to as delivered at place. So now what is the tax effect of this transaction? The tax effect of this transaction is that the goods never left the international border, right? Never crossed Nigeria. The goods are still within Nigeria. So the people that are going to claim the VAT on that is not the Nigerian Customs Service. You will just still have to pay your VAT liability of 7.5%, like you would normally do if you are selling the products to another Nigerian firm. So all these three, elements are integrated in the NTA, most especially under section 146 of the NTA, right? Another validating element that we have to pay attention to is the import VAT valuation, right? So now we refer to Incoterms. Under Incoterms, there is a basis to determining the value of a product. And under Incoterms, right, the VAT, the taxes that you pay, to bring a product into the country, these taxes are not included into the cost of your products under Incoterms. However, according to section 149 of the NTA, you actually have to embed the taxes that you have paid to bring that product, into the country, into a delivery state, into the country, right? Without excluding VAT. So this is what we are saying. For example, let's say you are trying to bring a product into Nigeria, right? Under Incoterms, you would not have added other kind of taxes, your custom duty, all those other taxes. You would have included them into the value of the product. But with the changes that were made according to NTA, you actually have to include these taxes on the cost of that product. So what that does is it increases the value of that product. So when you now eventually place VAT on it, you pay a higher VAT liability. So now we are going to be looking at the clearing agent documentary problem, right? So this is another challenge for businesses that are operating in international waters, right? So under section 155, subsection 4 of the NTA 2025, this section refers to input tax that is incurred by a registered person or any taxable person, right? So, and we are trying to see how this taxable person, right, can claim, input VAT. However, the wording of the law says that input tax incurred by a registered person on any taxable person made to such a person may be deducted from the tax payable made to such person, right? What are we saying here? What we are saying is that the law is effectively restricting, companies from claiming input VAT on products because they are using their agents, right? So when you use your agents now to import a particular product, right, the law is telling you that the input VAT on such a product, right, is going to be enjoyed by the agent, not the company, if you do not have sufficient documentation. That is essentially what we are trying to say, right? And when you look at the document, the importation document, you will see that on the bill of entry can actually carry the agent's name, right? Maybe you are somebody who you don't want to dabble into, the import and export process, and you just, contract your import of goods to a particular agent, right? It is the name of that agent that is going to appear on such documentation, meaning you as the company might not be able to claim the input VAT on such a product. It should be the agent, right? Now, what is the proposed solution to this challenge? The proposed solution is, number one, the clearing agent issues a VAT invoice to the principal, right, for the import VAT, right? So you issue a VAT invoice to the principal. The invoice that you're going to be issuing to the principal specifies the products and now additionally specifies, the VAT on that particular import. So apart from that, we also have, documents, right? So the documents are going to be both held by the clearing agent and also by the principal. So the principal can actually show that such an import of, products are being made on behalf of the principal, is not for the agent, and the agent is actually working for the principal. So you can also have, agency agreements also between the principal and the agent. So these documentations are actually very, very vital, so you can claim, your input VAT on imported products. So I'm handing over to Ife now to take us to the next phase. Back to you, Ife.
Thank you so much, Mr. Kola. I hope we're learning a lot because here is done justice to legislation, done justice to time of suppliers, that's Incoterms, and the cross-border VAT. So but right now, we'll be launching our first poll. And the question says, does your business have a documented VAT supply classification for each product or service line, including the statutory basis for that classification? The first option says, yes, formally documented and updated for NTA 2025. The second option says, yes, but based on the old VAT Act, not yet updated. The third option says, informal classification, not formally documented. And the fourth option says, no formal classification exists. So we're given 1 minute for us to answer this question. Thank you.
Okay, so based on the results of the poll, right, seems businesses, average of the respondents that we are seeing on the poll, they have formally documented and updated VAT supply classification for each of their products, right? So which is a good thing. But we'd also have, 50% who don't also have, proper documentation for their VAT supply, area, right? So this is not a challenge that cannot be resolved, right? And we are going to be discussing in the next slide what this means for your business, right? So right now, we are looking at the third pillar, which is going to be referring to exempt and zero-rated goods, the reclassifications. So when we are talking about the reclassifications of exempt or zero-rated goods under the Nigeria Tax Act 2025, right? The most distinguishing change that occurred is the reclassification of oil and gas exports, right? So this directly affects businesses who are operating in the oil and gas sector. right? So for oil and gas exports, it was previously zero rated. It's previously classified as a zero rated product. Remember in the previous slide, we explained that zero rated products are products that you can claim input VAT on, with proper documentation, but you charge 0% output VAT, right? Now, under the new Tax Act 2025, this has been reclassified as exempt, right? So you can have your VAT on drilling, offshore services, transport services, and every other thing are permanent costs. So you see why it is important for us to know the distinction between exempt products and zero rated products. So for exempt products, all these other costs, your input VAT and everything, serves as permanent costs that are integrated into your service price, into your product price, right? So for all other exported goods, apart from non-oil, exports, right, they are still zero rated, according to section 186, subsection N, right? Now, another addition is CNG, LPG, and solar equipment. So we have been seeing a lot of advancements, when it comes to CNG, LPG, people who are switching to solar, right? So these products, we're actually VATable at 7.5, but they have now been suspended, right? The VAT on these products have now been suspended according to the 12th schedule. However, this can also be, changed by a ministerial order, which is going to be published in the official gazette, right? Another classification of goods, another supply category are baby products, locally manufactured sanitary towels. So these were initially taxable under the old, under the old Tax Act at 7.5%, are now exempt. So we have humanitarian or donor-funded goods. They were previously zero-rated. They are now exempt. We also have agricultural equipment. Now, for agricultural equipment, right, so we are saying it varies. The reason why we are saying it varies is because we have different, stages of agricultural production, right? So when you are using your tractors, your plows, your harrows, and harvesters, all this machinery that you use for agricultural produce, when you are using them in primary production, then we can say the VAT on it, they are exempt, activities, right? So they are exempt from VAT. However, immediately you move up the production ladder or the production stage and you start looking at, secondary or tertiary agricultural produce, then we can say VAT still also applies to that particular product, right? Now, let's now look at basic food items definition under section 188 of the Nigerian Tax Act 2025. This section directly speaks to businesses that are operating, in the food industry. If you're operating in the food industry, this is directly speaking to you, right? According to the law, basic food items refer to agriculture-based or aquatic-based staple food, right? So you can also go through section 188. There is an exhaustive list of, food items that are classified as basic food items, right? We also have zero-rated food items also. Now, this is where we need to pay attention to. There are also some food items that you might easily think are zero-rated, but are actually still VATable under NTA 2025. And these include your processed snacks. If you're into the business of selling processed snacks, you are still VATable, right? You are not zero rated. If you are into the fast food, you're into the fast food business, you're into the restaurant business, you are still VATable. Confectionery or sweets, you are into carbonated soft drinks, flavored beverages, you are also VATable. You are into processing, selling of processed or ready to eat meals, right? You are still VATable. Now, we're going to be looking at the final pillar. Remember, at the beginning of this webinar, we said we're going to be discussing 4 pillars. We're on to the 4th pillar now, which refers to input VAT recovery. So as a business, entity, how do you recover your input VAT? Very, very, very important, because if you do not recover your input VAT, you're going to be exposed to a huge load of, VAT liability at the end of your fiscal or financial period or your reporting period, right? Now, we are looking at input VAT deduction and refund relapse. What are the two main things that you need to put at the back of your mind. The first thing, directly refers to section 155, subsection 4, that refers to input VAT deduction, right? So what this part is saying is you can only claim your input VAT for a maximum of 5 years. If you do not claim your input VAT within 5 years, such an input VAT is going to lapse, and you won't be able to, net off or claim such an input VAT against output VAT. That is if your business is, not zero rated, right? So you need to actually pay attention to this. So if you're operating a system, a capital intensive system where, now look at this. Let's say you are a capital intensive business and you're into construction, right? A VATable supply has already occurred. However, you have not received payment, right? And you've done a lot of processing, right? And the construction of that business, after construction, your payments didn't occur within 5 years, right? So that challenge now is going to be, is referring to you as a business, referring to how you can, re-strategize, how you can reposition your business so that you are able to claim input VAT within the specified period, right? That's what we are saying. Now, for the second aspect, right, this one refers to the NTA section 56. So this one is referring to the refund lapse rule also, right? So now what this part is basically saying is if you are trying to claim a refund, right, maybe you overpaid, or maybe at the end of the period you saw that, the VAT, you've paid more than what you are supposed to remit, right? So you can only claim this refund within 12 months. Within 12 months, starting from the when the taxable supply actually occurred, right? So you can only claim such a refund within 12 months. You see that this is different from input VAT. Input VAT is referring to when you net off, while the refund is referring to, when you are trying to claim back, the money that you have paid before, right? So these two are very, very important, most especially for businesses that like to claim their refunds in batches, or businesses that like to claim their input VAT in batches. So the next slide now is going to be, our last slide, and is referring to accrual basis, progressive supplies, and barter transactions. Now, we want us to pay close attention to this because this section 152, subsection 2 refers to a strict accrual basis, which many people are not aware of, right? So what are we saying under the strict accrual basis? Remember when we were defining time of supply, we said it refers to when the goods are delivered, payment is made, when an invoice is issued, whichever occurs first. Now, what that essentially means, basically, is that when the supply has occurred, as soon as we are able to establish that supply has occurred, the VAT liability has also followed it, even if you have not received payment. So if you are doing business on accrual basis, right, as long as the taxable supply has occurred based on the time of supply we discussed earlier, right, you are meant to charge VAT. So if you do not charge VAT as that taxable supply occurred, right, it's going to be a challenge because section 152 subsection 2 is following a strict accrual basis. Now, let's now move on to section 146 subsection 3b, referring to the progressive supply. So we also mentioned this briefly in the previous slide, that when you are making a progressive supply, right, or you are making an instrumental supply, then we can say the VAT liability or the taxable supply occurs when you pay or when you make an instrumental supply. So as you pay that installment, as you supply that good instrumentally, so also will the VAT obligation also follow. Not necessarily when you complete all the installments. It has to be as soon as the VATable supply occurs. Now, let's move on to the next one, which are barter transactions. So according to section 148, for barter transactions, we are saying for the two parties, the two counterparties, the both of them are taxable. So we've seen cases where you have related parties that say, oh, we want to do a barter transaction, we're going to give you this service, you're also going to give us this service, we're going to give you this good, you're also going to give us that good. And they feel they can just net off their VAT positions. No, that has changed according to section 148 of the NTA, right? So what now applies is if you are party A and you are supplying the product to party B, you are meant to add VAT on your invoice to party B. Then if party B is also supplying you based on how barter works, party B is also supposed to add VAT to their invoice. That is how the new system works. Now, you see, the worst part is when you now do barter with an unregistered counterparty, right? So what do we mean when we refer to an unregistered counterparty? An unregistered counterparty is a party that, is not registered for VAT, right? So they are not registered under VAT, they don't have a valid tax ID number, so on and so forth, right? So now you, who are a registered party, if you now trade or you transact with such an unregistered counterparty, right, you will be the one to be paying the VAT liability, right? Because you are the one trading with someone who is unregistered. So you actually have to self-charge your VAT that person is meant to pay because that person is not registered. So you yourself will have to self-charge on such a transaction and remit. So if you don't, right, it's going to become a liability for you eventually, right? So also, we also have people who are transacting with businesses that are small business. Because a business is a small business, that automatically exempts them, right, from charging VAT. So in such a scenario, what do? Right? You who are the registered party, you still owe output VAT on the supply, right? So you will still be the one to bear the crux of such a transaction or such liability. So over to you. We're going to be having our second poll now. Over to you, Ife.
Thank you so much, Mr. Kola. I mean, this is a really like breakdown of the whole VAT rule, talking about exempt, talking about zero rated, accrual basis, and the likes, even the progressive transition. Thank you so much for that. So we'll be launching our second poll now. And the question says, does your business actively track the 12-month window for VAT refund claims on net impute credit positions? The first option says, yes, we have a process for monitoring refund entitlement. The second option says, we claim refund but do not track the 12-month window specifically. The third option says, we carry credit forward on returns. We do not file separate refund claims. And the fourth option says, we were not aware of the 12-month rule before today. So we're giving 1 minute for us to answer this poll. Thank you. Has been answered, we would move to a Q&A segment. I've actually been monitoring the chat throughout the session, and we have some really strong questions to walk through. I would read each question, direct it to Kolawole, and also invite David to add where relevant. We just have 8 minutes, and so the questions now addressed today will be answered in writing in the possession summary. So, and this possession summary, all the registrants will actually receive them after this. Yeah. So I think there's a question from Oluwakemi Buraimo. And the question says, could you please clarify the VAT implication for training services provided outside Nigeria for employees of a Nigerian company? For instance, where a physical training session is conducted in South Africa, for example, for employees of a Nigerian company by the company's registered vendor, would such service be regarded as having been consumed in Nigeria for VAT purposes? Let me take that again. From Oluwakemi Bremo, The question says, could you please clarify the VAT implication for training services provided outside Nigeria for employees of a Nigerian company? For instance, where a physical training session is conducted in South Africa, for example, for employees of a Nigerian company by the company's registered vendor, would such service be regarded as having been consumed in Nigeria for VAT purposes? Over to you, Mr. Kola.
All right, thank you, Ife. So to answer that question, section 145, subsection B(I) of the NTA 2025 specifically says that if a supply is deemed to have been provided to or consumed by a person in Nigeria, right? So the law is regardless of wherever the supply was being made from, right? Such a service or such a transaction is VATable. So they are not looking at where the service is coming from. They are only looking at where the service or the product is consumed. So the same also applies to goods. So if the goods are physically present in Nigeria, right? If it was brought into Nigeria, if it was imported in Nigeria, if it was assembled in Nigeria, right? Such a product or service is VATable.